Planning for early retirement. Many people seeking freedom from the traditional 9-to-5 grind and the opportunity to pursue their passions have been drawn to the concept of early retirement. The prospect of saying goodbye to work at a younger age and embracing a life of leisure, travel, and personal fulfillment is undeniably appealing. To achieve long-term financial independence, early retirement requires careful planning, disciplined financial management, and a comprehensive strategy. The difficulties of early retirement planning will be explored. We will go over the critical steps and considerations that will help you pave the way to financial independence and lay the groundwork for a fulfilling post-career life. We will walk you through the essential elements of early retirement planning, from setting clear retirement goals and managing your finances wisely to investing strategically and adopting a frugal mindset. Early retirement can be an ambitious financial goal, but with the right plan in place, you can reach it. Here's a 7-step course of action that can help you determine if early retirement is possible and what you'll need to do to make it happen. Increasingly, employers are not offering traditional pensions to their employees, which in the past allowed them to supplement their guaranteed income and potentially retire early. If you have a pension with your employer, you are in a lucky minority, but it may not cover all of your expenses if you plan to live large in retirement. With or without a traditional pension, it's important to have a plan in place if you wish to make your dream to retire early a reality. Here are 8 tips to work towards achieving early retirement. 1. Contribute to your workplace retirement plan. The best place to start is by contributing to your workplace retirement plan. You want to always contribute at least the amount your company is willing to match you. It's free money. Once you've reached your employer match, try to increase your contribution by 1% every 6-12 months. Some plans offer the election for this to be done automatically to avoid having to remember on your own. Check with your HR department to find out if your company matches any contributions and whether you can set up automatic increases to your contribution amount. Not eligible for a workplace retirement plan or is one not offered by your employer. There are other ways to save: IRA, Roth IRA, SEP, etc., for retirement. Speak with a financial advisor to determine the best option for your situation. 2. Avoid withdrawing from your retirement accounts early. It may be tempting when you see a sizable balance to take a lump sum out for a large purchase. However, the longer your assets are invested, the more potential for growth. Another reason not to withdraw from your retirement fund. In most cases, the IRS charges a 10% penalty for withdrawals taken before age 59.5, in addition to having to pay ordinary income tax on the amount withdrawn. So, remember, always keep your eyes on the prize. 3. Ask yourself what's more important to you. Do you want to live your best life now or in retirement? You don't have to choose one or the other, but when making financial decisions, it's an important question to ask yourself. In most cases, we want both, so it's best to remember this question and then compromise. If early retirement is one of your top priorities but you enjoy traveling, compromise and instead of going on a vacation every year, go every 2 years. 4. Pay off and avoid debt. This may seem obvious, but it's important. Each long-term loan that you take on jeopardizes assets that could be used for retirement purposes. In addition, you're increasing your costs by having to pay interest, a completely unnecessary and avoidable expense. To increased costs from interest being paid. 5. Invest early and often. If after paying your fixed expenses you have discretionary income, consider automatically directing a portion to an investment account to utilize for savings and retirement. Use the power of compounding to your benefit. 6. Consider a health savings account, HSA, for health expenses. Healthcare costs are one of the main concerns when individuals contemplate early retirement, and HSAs are an often overlooked tool for savings. HSA accounts, offered in conjunction with some high-deductible healthcare plans, allow for you to contribute tax-free, have the assets grow tax-deferred, and make withdrawals for qualified expenses tax-free. Contributions made to the account carry on year to year and even carry on with you if you change employers. If you can avoid withdrawing from the health savings account during your working years, any amount remaining can be used in retirement for qualifying health needs. It's not for everyone, but it's worth considering and asking your advisor if it makes sense for you. 7. If offered, take advantage of employee benefits such as employer stock plans. You may have the ability to purchase company stock at a discount or get a matching contribution from your employer. Check with your HR department to see if there's an option available to you. 8. Set up multiple sources of income. This could include investing in income-generating assets such as a rental property or small business, or more traditionally, taking on a part-time job or side hustle. Alternate income streams help to cover your cost of living so you can save more towards your end goal. People are living longer and therefore have more years to cover in their retirement. Retirement can mean different things to many people, whether it's moving to paradise, spending more time with your family, or being able to do something you truly love such as volunteer work or traveling. Whatever it is to you, the more you plan now, the better position you will be in the future to set yourself up for retirement and maybe, if you're lucky, fulfill your dream of early retirement. 9. Consider health insurance and long-term care. It is critical to account for health insurance and potential long-term care needs when planning for early retirement. Investigate and compare health insurance options to ensure you have adequate coverage during your retirement years. Examine the costs and benefits of long-term care insurance or look into other options for dealing with long-term care costs. You can protect your financial well-being and reduce potential healthcare-related risks in retirement by addressing these issues early on. 10. Seek professional financial advice. It can be difficult to navigate the complexities of early retirement planning. Consider consulting a certified financial planner or a retirement specialist for professional financial advice. They can assist you in analyzing your financial situation, developing a customized retirement plan, and offering advice on investment strategies, tax planning, and optimizing your retirement income. Working with a professional can provide you with peace of mind and increase your chances of achieving your early retirement goals. 11. Evaluate lifestyle adjustments. Consider evaluating and modifying your lifestyle to support your early retirement goals. Determine areas where you can potentially save money without sacrificing your quality of life. This could include downsizing your home, reducing your discretionary spending, or looking into more cost-effective leisure activities. You can accelerate your savings and retirement timeline by making deliberate choices and living within your means. Conclusion. Early retirement requires discipline, careful financial management, and a long-term outlook. You can achieve financial independence and early retirement by defining your retirement goals, assessing your finances, saving aggressively, investing wisely, and minimizing debt. To stay on track, remember to constantly monitor and adjust your plan. Early retirement can become a reality with the right strategy and commitment, allowing you to live a fulfilling and rewarding life. If you find this video useful, don't forget to like and subscribe to our channel.